Okay, welcome to the second semester of accounting. This is called Accounting 2, and it is like the other course, a semester course, and it follows what hopefully you've already learned in Accounting 1. So, just a couple things before we look at the screen here. First of all, I hope that you have looked at the course announcements at the top of your page, and I'll remind you to do that every day because information will be there on a daily basis. So be sure you check course announcements every day and follow that information. Also, you will see that as in the past, I have a saint of the day that we had in the first semester. So make sure you read about the daily saint and do the prayer, and that will be our way of beginning the class each day. Now let's take a look at the screen, and I want to give you an idea of what's in store this second semester. We're dealing with the accounting cycle, and you've done quite a bit with that already. You learned how to journalize transactions into a general journal and then post those bits of information into the general ledger. We talked somewhat early on about the two financial statements, balance sheet and the income statement. We're going to begin by finishing this accounting cycle. There's a few more things to do before we go on beyond it. First of all, in December, right before the exam, you started a bit on cost of goods sold, and I want to come back to that, and I'll give you a bit more information today on that. Also, we're going to be taking a look at depreciation, and this is in context of the major assets that a company might have. For example, there were a number of times when you had a problem that had you journalize a transaction indicating that the company bought a delivery truck, and you debited delivery truck and credited cash or credited accounts payable. But depreciation gets into what happens after that purchase of that major asset like the truck. What happens after the second year and the third year when that value of the truck goes down? How does the company handle that? So we'll talk about those kinds of entries into the journal and the ledger. And then something called closing entries. If you remember, when we looked at accounts like revenue and expenses, I told you that at the end of the accounting period, those accounts end up with a zero balance, revenue and expense accounts. The other accounts don't. They keep their balances. Whatever you end up with cash, for example, at the end of the accounting period carries over to the next accounting period. Not so with revenue and expense, and we'll explain why that is and how that works. So that's a process called closing entries, and we'll take a look at that. Then we will revisit the accounting cycle in a bit of a different way. We will look at something called multi-column journals, which will be a much easier, more time-efficient way of journalizing transactions, especially if there are an awful lot of them. So we'll look at different kinds of multi-column journals. They're called multi-column because instead of just a debit and a credit, they have more columns for you to use. And you'll find that's not quite as difficult as it might sound at this point. In fact, it'll save time. Then there's something else that we will learn called subsidiary ledgers. You dealt a lot with general ledgers. This will be subsidiary ledgers where we keep track in more detail of how much customers owe to us and how much we owe to our creditors. We will deal with a little bit more with sales and with purchases. Sometimes there are discounts. We may give a customer a discount if he or she buys or on a regular basis, or there's a sale going on. So we need to be able to handle that in our books. Same way with purchases. Sometimes we buy something and we get a discount, meaning our business. And sometimes sales are uncollectible. Sometimes we make a sale, but the customer doesn't pay what he or she owes to us. We need to know how to handle that. We will deal with something called adjusting entries toward the end of the semester, and then take a look at a couple more financial statements if we have time in the course. So that's a very brief look at what's in store. And I want to go to a tab at the bottom of the page right now and click on this. This should look familiar. This is a problem you had in the semester exam, I believe. And it is an example of how we handle payroll. Remember at the very beginning, salary expense was debited, cash was credited. That was very simple. And then we expanded it quite a bit. We had all these liability accounts to deal with, and then we had to pay the liability accounts. Here you see an example of paying the federal income tax payable, and we paid cash, so cash is credited. So these are part of what you should already understand. These types of payments are made on a quarterly basis every 3 months, and we need to know how to handle that. So we're not going to spend time with that again, but just as a reminder that things get a bit more complicated than they were at the beginning. And if you remember also scrolling down, FICA is even more complicated because this particular account is paid half by employees and half by employer. So these last two transactions entered into the journal deal with that. So the next tab down here, this also is from the semester exam, I believe, and this deals with what we have learned already about cost of goods sold. So in this company, Ace Hardware, on December 12th, they bought some inventory for cash for $24,000. Then they bought some inventory the next day on account. They charged it for $72,000. Okay. Then we made a sale. We debit the cash receivable. If we made a sale, we don't credit inventory, we credit sales. And the sales amount was $50,000. Then we had to figure the cost of goods sold. And hopefully you remember that process. What I want to point out to you here is over here in the instructions, we bought on December 12th inventory 300 items at $80 each. Then the next day we bought inventory again, 900 items. We charged it, but we bought them on account at $80 each. So each time we spent $80. So that made it fairly simple to figure out how much the cost of goods sold was. However, the difficulty that we'll see in the rest of topic 7 deals with situations where this $80 wouldn't necessarily always be the same, because costs go up. So if we bought on December 12th inventory at $80, maybe even the very next day costs go up, and maybe this is $90. So that complicates things a bit. So that's where we will start with the rest of topic number 7. We'll talk about cost of goods sold in a real world environment where costs go up, and our inventory costs us more and more and more, and we have to somehow handle that accurately. So after this video, there are some questions for you to answer, and let's do that now.